Good evening. I'm Professor Macari, and I'm going to be taking you through the weighted average cost of capital and capital budgeting concepts that are going to be essential to your 640 project. And I think it's important to note that the project that you're going to be working on in this 640 class is going to be evaluated by the corporate parent of your company based on its return on capital. And so what we're going to talk about today is the difference between creating income, which is an accounting concept, creating value, which is an economic concept, and then we'll talk about the specifics of how do you calculate the threshold rate, which is the weighted average cost of capital, and the techniques for evaluating project return, such as internal rate of return, modified internal rate of return, and net present value. Okay, so start with the difference between creation of value and creation of income. And then we're going to talk about cash flow versus accounting income and investing above weighted average cost of capital. So what's income? Income is an accounting concept. And that accounting concept basically has to do with matching revenues and the expenses that generate those revenues. And basically, if you have more revenue than expense after taxes, you've created net income. But remember, that's an accounting concept. It basically means when you hear the term that something is accretive to earnings, it means it added to net income, and basically if it's an investment, that it covered the cost of debt. That doesn't necessarily mean that it provided a return to common shareholders, and this is going to be our point of difference in what we discuss. So economics is always about cash flow, right? When we talk about finance, the primary difference between finance and accounting is that accounting is more concerned with an accurate matching of revenue and expense, and economics or finance is more concerned about cash flow. And for cash flow purposes, remember back to your basic accounting and finance class, we add back non-cash items like depreciation, and we're concerned with whether or not we have to put more working capital into the business or more equipment. So what we're going to talk about today is we're going to talk about how you're going to evaluate this for your project. Okay, let's take a very simple example. Let's say that we have a company that can raise $5 million of debt at an after-tax cost of 3% and $5 million of equity at an after-tax cost of 10%. So if you came to my office first with a $5 million project, that you'd say, hey, look, I have a project that's going to return 5%, and I know our borrowing cost is only 3%, we should do the project. I give you the $5 million. 5 minutes after you're in my office, the next person comes through and says, I have a project that's going to give us a 9% after-tax return. What's the issue? The issue is somebody else has already used up all the less expensive capital, and now I have to reject your project because it doesn't cover the cost of equity, which is more expensive. Clearly, we took on a less valuable project versus a more valuable project, so we've made a mistake. So the concept of the cost of capital, or more appropriately, the weighted average cost of capital, is that if we had this particular project and structure in mind, as I said before, 50% debt, 50% equity, total capital budget of $10 million, I would have weighted averaged the two costs. I would have said I have half of my capital structure at a 3% after-tax cost, half of my structure at a 10% cost, average them together, 6.5%. So that would mean that every project would have to have a return of greater than 6.5%, or we wouldn't take it on. Notice that if we were just looking to add to income, net income, the accounting concept, what we would do is basically be willing to take on anything that gave us more than a 3% return. But that's not what we're interested in. Corporations create value over the long term by investing above their weighted average cost of capital. So when we talk about cost of capital and long-term capital, what are we really speaking about? What we're really talking about are three primary forms. Long-term debt, which is when a company issues bonds or takes on debt that's due in more than 1 year. preferred stock, which is generally going to be non-voting stock, which investors purchase because it has a higher dividend yield than common stock. Notice part of what you get is you get a higher yield and you get preference. Those shares have to be paid their dividend before the common shares, but you don't have a vote. And you also don't share in the upside of the company. When we talk about common stock, there's basically two ways when we talk about common stock or common equity that we can raise capital. The first is retained earnings, which are funds that are already in the company. Usually it could be in the form of cash or other assets, or issuing new common stock. And part of what we're going to discover when we calculate the cost of capital is that even though, when you think about it, a company that may have a lot of cash, for example, an Apple computer, that's not their money to just do anything with. That belongs to the common shareholders. That means, by definition, that the shareholders are entitled to a satisfactory return on that capital. If the corporation can't give that to them, then they should give the money back to the common shareholders and let them find something else to do with it. So when we talk about our formula, the formula looks a little complicated, but it's really not. And the formula is basically that the weighted average cost of capital equals the weight of the debt, which is the percentage of the capital structure that's comprised of debt, and the after-tax cost of the debt. Notice that when we talk about the cost of debt, we multiply by 1 minus the tax rate. And we do this because interest expense is tax deductible. So the part of the cost of the debt gets tax affected, and there's a tax benefit for it. We add to that the weight of the preferred stock times the cost of the preferred stock. And then we add to that the weight of the common equity and the cost of the common equity. And notice that we don't tax affect either the preferred shares or the preferred dividends or the common dividends, and that's because they come out of after-tax income. Therefore, there's no tax benefit. And if you look at an income statement, you'll notice that interest expense is above the line and dividends come out below the line or below the net income line. So normally when we calculate the cost of capital, and we're going to do this for your company later on in the course, when we try to figure out the cost of debt, it's going to be the yield to maturity of the existing company bonds, normally 10-year bonds. And if you think back to Finance 603 and some of your prior finance coursework, the difference between the yield to maturity and the coupon rate of a company and their debt is going to be the difference in price that you pay. In other words, the coupon rate is the stated rate of interest on the bond, but your yield to maturity is going to also include whether or not you have a capital gain or loss based on what price you paid for the bond. And the yield to maturity also provides us, more importantly, with an idea of what it would cost us today to go out and raise money. Remember, the coupon rate is a historic rate. It's what we did in the past. Anytime we're talking about cost of capital, we're always talking about what's it cost us to raise our incremental or next dollar. For preferred shares, and not all the companies that we're going to talk about have preferred shares, it's basically the dividend yield. It's the dividend divided by the price, and that's going to be our cost of preferred. And for most companies, preferred is not a big component of their cost of capital. For common equity, which is the common shareholder return, we have two primary methods we're going to use. One of them is called the capital asset pricing model, and one of them is called the DCF, or dividend yield plus growth methodology. For the capital asset pricing model, you can see the formula there is the risk-free rate plus the market risk premium times beta. And while it sounds complicated, again, thinking back to your Finance 603 course, all it's really saying is for the risk-free rate, that's the rate of a 10-year U.S. Treasury bond. The idea being nobody would ever take less than the risk-free rate because they could get that rate without taking any risk. Currently, and this is being taped in May of 2016, the U.S. 10-year Treasury is between about 1.9 and 2%. The market risk premium. The market risk premium represents how much does the average stock have to pay in addition to the risk-free rate. So for example, if the average stock in the market provides an 8% return and the risk-free rate is 2%, that would mean the market risk premium is 6%. That's what you would have to give to a shareholder to get them interested in buying your company. And then we multiply that market risk premium by the beta. And the beta is representative of your individual company and how risky it's considered related to the average stock. For example, companies like Procter & Gamble, Johnson & Johnson tend to have relatively low betas. Why? Because even in a bad economy, when other stocks might be getting hurt, people still have to buy those products. Companies that tend to have very high betas are companies that go up much more in an up market and down much more in a down market. And those could include companies like some high-tech companies as well as things like biotech companies. So for the average company that we're going to be talking about in the consumer products area, we're probably going to be talking about a risk-free rate of about 2, a market risk premium which is historically ranged between 5.5% and 6.5%, and a beta which is normally going to be somewhere for a consumer products company, normally somewhere between 0.5 and a little bit over 1. Again, for a higher risk company, it's going to be a much higher beta. The dividend yield method we won't use as much in this class, though it's a very valid way to look at cost of equity, and what it represents is the dividend yield of the company plus growth rate. So, for example, a company like Procter & Gamble that has a 2 to 3% dividend yield and has a stated long-term growth rate of about 4 to 5%, their cost of equity in the current marketplace will be somewhere between 7 and 8%. One of the things we're going to talk about is, should the company use the composite weighted average cost of capital as the hurdle rate for each of its projects? And the answer is no. When we talk about the weighted average cost of capital, the weighted average cost of capital is the cost for the average project taken on by the firm. So, for example, one of the tasks you're going to do in 640 is you're going to create a new product. You're going to launch a new you're going to provide the marketing and create an idea for a new product. Well, companies like Procter & Gamble, Unilever, this is what they do all the time. So, in likelihood, your project would be treated with whatever the company's cost of capital is. But let's say you were going to take on a much higher risk project. So if you were doing this for Unilever or Procter & Gamble, as opposed to a typical consumer product, you wanted to launch a new automobile, or you wanted to launch a new series of Procter & Gamble drug products. Well, that would be higher risk, and we would have to assign a higher return to it, or assign it a higher weighted average cost of capital. And you'll also see in 641, when you try to take your product to a new country, that we also may have to include a risk premium as you take this project to a new country. Again, when we're talking about multinational companies like the ones we work on in this course, like Unilever, Procter & Gamble, Diageo, they're already launched in just about every country on the planet. If your product is going to be launched into a market that they already sell products in, the risk premium would be relatively small, versus if you were going into a completely new high-risk market where there's greater risk of repatriation of capital, difficulties in entering that market, etc. We'll talk about this a little more in 641. So, theory versus application. We just talked about the theory. And the theory is that that we're talking about assessing the new, or going into the capital markets for new capital. When we say that we're going into the capital markets, that just means that we're going to sell bonds, we're going to issue stock, or issue preferred stock, because we don't have sufficient funds available in-house. Most of the companies that we're going to cover in this course, excuse me, most of the companies we're going to cover in this course are large multinational companies. Therefore, if you're only looking for $10 to $20 million of capital, they're not really going to have to sell stock or issue bonds to get to that. They're basically going to take that out of retained earnings. But this isn't free money. This is money that, again, you're going to have to earn the cost of capital on in order for the company to appropriately determine whether or not to allow you to invest. Again, remember the example I worked on earlier, where if all we did was sort of charge you the incremental cost of debt, we'd be undervaluing the cost and therefore overvaluing the value created by your project. So again, even though we're going to take this money most likely in this course, we're going to take it out of existing funds within the corporation, we're still going to have to cover the cost of capital as our hurdle rate. Excuse me. So again, your project, as I just said, is not free money. It's money that belongs to the common shareholders. We see this all the time in the marketplace where companies that have a lot of excess cash, they're being pressured by shareholder activists to provide them with either issue that money in dividends or go do something important with it. So again, we're talking about consumer products companies that are international. Part of what they do to create organic growth, which is growth that you don't get via acquisitions, is they go out and launch new products every year. That creates organic growth. That improves the price of the stock, and that benefits the common shareholders. Okay, again, just as a reminder, the cost of capital, we always view this on an incremental basis, which is how much does it cost us to raise the next dollar of capital. And we weight average the costs based on what our capital structure is, and ideally what our ideal capital structure should be. For the purposes of this course, we'll probably stick with the existing capital structure. Okay, so how does this really happen? In a company, at all times, your Treasury Department is observing the capital markets, determining are we appropriately using a mix of debt and equity? Are we tapping the capital markets at the right times? Should we be reissuing our debt at lower rates? Should we be levering up our company with more debt? For example, right now, interest rates have been so low over the last few years that many corporations, even though they don't need the funds, are going out to borrow money because it's a low cost source of capital. And they're using that to go out and give issue dividends or buy back shares. So right now, the capital markets, there's a lot of money out there, and there's a lot of companies taking on debt. When interest rates go back up, which is at this time in May 2016, a real potential as the Federal Reserve may increase interest rates, the concern is the higher up interest rates go, the less active companies will be in the capital markets. So one of the quick questions that always comes up is, since debt is a lower cost after taxes than equity, why don't companies just take on 100% debt? And the reason is, obviously, as you know from your prior finance coursework, nobody's going to just let you borrow an unlimited amount of capital. Even if you're a multinational company like a Unilever or a Diageo, there's a lid on what people are going to be willing to lend you at a certain price. The greater your leverage, which means the more debt you have related to equity, the greater the cost of each incremental layer. So most companies will target trying to keep, most of the consumer products companies we're going to talk about, they're going to try and keep at least an A rating. And an A rating, which is going to be issued by Standard & Poor's or Moody's, is really going to be based on the financial ratios, some of which we've covered earlier in this course, and how strong a company's financial ratios are. So the answer is, why don't companies focus solely with debt? Because with each incremental layer of debt, you not only increase the risk of the company, you increase the cost of the debt. So companies try to find that right balance between debt and equity. We're going to talk about book versus market. And when we talk about book versus market, what we're talking about is the capital structure of the company. When we talk about book value, we're going to use the balance sheet for our corporation to determine what's the percentage of debt, what's the percentage of preferred, if we have any, and what's the percentage of equity. When we talk about the market value, instead of using balance sheet values, we're going to actually use the market cap and current bond prices of the company to determine how much weight each component receives. As you know, bond prices change every day, and the market capitalization of the company, which is the current market value of the stock times all the shares outstanding, that gives us the market cap of the company. And most of the time, the market value of the company is going to be much higher than the book value. That's the whole idea of having a management team that's going to bring greater value to your shares. I just pulled an example for Unilever. This is from their 2015 year-end balance sheet. It was represented in Great British pounds, but it just gives you an idea of the methodology. So if we looked at their balance sheet, we saw that they had about $4.7 billion of short-term debt, about $9.9 billion of long-term debt, and common equity of about $15,439. So that gave them total capital of about $30 billion. And if we just calculate the percentages, you could see that they had almost an even mix of debt and equity, about 49% debt and about 51% equity. So this is a relatively normal thing. When we look at it at the market basis, though, and for our purposes, we just assume that all the bonds trade at par. The practicality is we didn't have access to a Bloomberg terminal when I did this. Our debt is about 14.6, but notice that the market cap of the company, the market value of the equity dramatically increased. It went from about 15 million, which is the book value of Unilever, to about 92 billion. Why? Well, the value of Unilever is not in the hard value of the assets. The value of Unilever is the brands, the brand names, the new products, the ingenuity, and the intellectual property they have. So obviously here we end up with a much larger total capital number. So our percentages dramatically change. We have about now, instead of about a 50-50 mix, we have a much lower percentage of debt, about 14%, and about 86% of equity. Since equity is a more expensive form of capital, we're going to see our cost of capital will go up based on the higher level of equity. So how do we find our cost of debt? Well, one of the places to go is Morningstar.com or investinginbonds.com, or if you have access to a Bloomberg terminal, that's probably the easiest way. But you can use either of these other two sources to find the yield maturity of a bond for your company. So I did this, and basically we try to find a bond with a 10-year maturity date. Why? That kind of puts us in the same ballpark as the risk-free maturity. And in this case, Unilever has a bond that matures in about 2025, has a 3.1% coupon, and a yield to maturity at 2.55%. Their tax rate's 28%. So if I wanted to know what it would cost Unilever to go out and borrow additional funds via a debt offering, it would cost them about 2.55% pre-tax or 1.84% after tax. And this is the cost of debt we're going to use for both book and for market. Okay, so now we've got our cost of debt, and there isn't any preferred for Unilever. So now we're going to figure out our cost of equity. So the first step is to figure out the risk-free rate. And at the time that I did this, the U.S. Treasury rate was about 1.98%. And we're going to assume for the time being that we're raising capital in the U.S. The market risk premium, as I mentioned earlier, is that extra return that the average stock has to give you in order to compensate you for the fact that stock has risk associated with it. So I just pulled something from the American Appraisal Association, and they suggest a rate of about 6.5%. And the beta for Unilever, excuse me, ranges, depending on the source that you use, between 0.71 and 0.86. So this just basically means that Unilever has a beta of less than 1, and therefore it's considered less risky than the average stock. So what I did was just take the average of 0.71 and 0.86 and came out at 0.79. So now we determine our cost of equity for Unilever. 1.98% is the risk-free rate, 6.5% is the market risk premium. We multiply just the market risk premium times 6.5%, and we come up with a total cost of equity for Unilever of 7.12%. Now we do our calculation. Remember our book value, 48% of the capital was debt at a cost of 1.84%, 51.3% was equity at a cost of 7.12%. This gives us a book cost of capital of about 4.55%. Our market, which is considered the more accurate of the two, and most companies tend to use market, notice that the costs don't change. Debt is still 1.84%, equity is still 7.12%. What has changed is the weight. In the market structure, only about 13.7% of the structure is debt, and about 86% is equity. When you multiply those out, you end up with a weighted average cost of capital of 6.4%. This means that Unilever would never do a project that gave them less than a 6.4% return. In general, companies will, though the theory is that they invest even if they just get slightly above their cost of capital, in reality, companies are going to use a different hurdle rate for all different types of projects. So I would believe that Unilever, because so much of what they do is launch new products, their hurdle rate for these is probably going to be relatively close to their cost of capital, let's say a few percentage points above. For more difficult investments, like making a large investment in a new country, or the most difficult, which is usually to make an acquisition, acquisitions always have much higher hurdle rates because of the fact that there's a lot of risk, and therefore to adjust for the risk, you're going to demand a greater cost of capital, or you're going to demand a greater return on your cost of capital. So that sort of just takes us to, okay, now we've established our hurdle rate. We know for Unilever, for example, in this sample, that we wouldn't take a project less than 6.4%. Okay, so now what do we do with that information? And what are you going to do with it in 640? Well, what you're going to do is, after you figure out the cash flows for your business, which we'll work on in a different section, you're going to have to calculate the net present value, the internal rate of return, and the modified internal rate of return on your project. So what do these really mean? And what we're going to do is we'll have a separate session where we go through with Excel, and I'll show you how to calculate these. But what do they mean? Net present value just basically means if I take all the cash flows that result from the project, let's say it's a 10-year project, I take the cash flows from periods 1 through 10, and I discount them, or find the present value of those projects, of those cash flows. What do I use for the discount rate? I use the cost of capital. And this makes sense. We discount these cash flows by the cost of capital, which means if we have a positive, positive net present value after we subtract out our investment, this means we not only recovered our investment, but we also earned a return greater than or equal to our cost of capital, or 6.4%. Our internal rate of so the net present value is expressed as a number, 100, a million, 20 million, whatever the whole number is. The internal rate of return and the modified internal rate of return are expressed as percentages, similar to the way that when we talk about the cost of capital. The weighted average cost of capital is expressed as a percentage. As we did for Unilever, it was 6.4%. The internal rate of return is also expressed as a percentage. And what it means is, what is the return that we have to earn to make our net present value zero? What does this basically tell us? This tells us if we were to discount our cash flows at the internal rate of return, we'd have a net present value of zero. Another way to look at this is if our IRR is higher than our cost of capital, we do the project, because by definition it'll come out with a positive net present value. Modified internal rate of return is basically the same set of calculations with one difference. The internal rate of return assumes that we can go out and find more projects like the one we just evaluated. So, for example, if we were to find a project with a 25% IRR, the IRR methodology assumes that that basically you can go out and reinvest at 25%. Well, that might be overly aggressive. The modified internal rate of return just varies the calculation slightly, and what it does is that it assumes that the reinvestment rate is going to be the cost of capital. So, for example, if we had a project with a 15% IRR, and then we ran the modified IRR calculation, we would assume that we could only reinvest at, let's say, 6.4% if it were Unilever. The result basically is that the modified IRR is a more conservative methodology. Normally is going to provide us with a lower return, but the concept is if you've got a positive net present value and both your internal rate of return and modified internal rate of return are greater than your weighted average cost of capital, then it's a go on the project. Just to cover some of the concepts here, we'll talk about mutually exclusive and independent projects. So all this really means is that two mutually exclusive projects would mean you're going to do one or the other, not both. So in your case, as you develop your new product, you may have different ideas and you may have to run the numbers on them. And the idea here is that you're only going to get one product concept, so you're going to pick the one with the best return. Independent projects would basically mean that as long as it's got a positive net present value and an IRR, modified IRR that are greater than your cost of capital, you would do both projects. And basically, on Blackboard, you'll see a sample of an Excel spreadsheet which will do the calculations, and I'll also take you through that in a couple of minutes. Capital budgeting, I want to move over to capital budgeting now. Again, this is really where internal rate of return, net present value, modified IRR are used. We won't be doing as much of this in 640, but it's important that you understand the concepts. What are the when we talk about capital budgeting versus operational budgets? An operational budget is basically your annual profit and loss statement. And the idea there is that that's just going to basically measure your operations. Capital budgets really relate more to your long-term investments, any investment that's going to take more than a year to pay off. So what are the sort of projects that we have? Well, very often we'll have things that are required maintenance. For example, we have to replace a building, we have to replace equipment. New technology. We're seeing constantly that corporations are changing, not just replacing computers, but figuring out completely different ways to improve the technology of their business. Anytime your company goes out and buys computers, that's part of the capital budget. Compliance. Any building or any manufacturing facility is going to have to comply with OSHA and environmental requirements. And these days, those requirements are getting more and more detailed and therefore more and more expensive. Expanding to new markets and new products, this is really what we're going to focus on in this class, as you're going to create a new product and ultimately move it into a new market internationally. What are some of the, efficiency investments? Usually are purchasing equipment or technology in order to replace human labor. And most companies make investments every year in order to improve their productivity. Where do we find where capital investments are made? Again, we don't run this when we think about when we first purchase a building. Let's say we purchase a building for $20 million. Well, that doesn't run through the income statement immediately. The first thing that happens is it shows up in the cash flow statement under the investing activities. Then that amount that we invested goes onto the balance sheet as a fixed asset. So, for example, in the sample I just used, if we were to buy a building for $20 million, you'd see an item on the investing activities of $20 million for the investment in buildings. On the balance sheet, you'd see a fixed asset increase of $20 million for the building. And then once we started to depreciate the building, then you'd see the depreciation show up on the income statement. When we got to the cash flow statement, you'd see the investment for the building, but we'd be adding back the depreciation because it's a non-cash charge. Normally what happens is companies usually do their annual planning process on a 3-year basis. Based on my experience, most companies usually do a budget year and then 2 out years to kind of see what the long term or the intermediate term looks like. They're also at that time going to do a capital budget, and what that means is that they're going to go out to their subsidiaries and say, tell me all the equipment, all the investment that you want to make to grow your business over the next 3 years. That all comes into corporate, and then they prioritize. They go by which is going to provide them the greatest return. They try and prioritize by how much they can really afford to spend in their capital plan. They go by which are necessities and which are luxuries. And then the company basically it's a back and forth iterative process where they go back and forth to the subsidiaries to say, okay, here's how much capital you have, and these are the projects that we're approving. There's a couple of examples here that I think are important. Obviously numbers and returns are important when you talk about capital budgeting, but part of it, the real skill isn't running the models, because I'll show you how to do it in Excel. It's basically loading data and running numbers. The key is understanding the numbers. So here's a sample. So your company's been told by OSHA to make a safety improvement. Your management team and your director of safety, talk to other people in the industry, and they basically say, it's kind of a waste of time and money. Nothing's ever going to happen of it. So the cost of improvement is $1 million, and it's going to have to be updated every 2 years for an additional $1 million. The OSHA fine for failing to make the improvement is $1,000 per day. Well, you can do the math in your head. You can either spend $1 million every 2 years to make the improvement, or you can pay $365,000 a year in fines. The quick answer is you'd pay the fines. But is that really the way you want to do business both from an ethical standpoint and a legal standpoint? Obviously, thumbing your nose at OSHA and the government is never a good idea. If anybody were to be injured when you're out of compliance, you'd also have liabilities there. So even though on a quick analysis basis you would look at this and say, okay, I save, I spend $1 million, or I'm charged $365,000, it's a no-brainer. I pay the $365,000. There's bigger considerations here. We'll skip over a couple of these examples that you can work on and look on your own. One of the other things that we're going to do when we do your calculations on your project is you're going to do a projection of 3 to 4 years. Once you finalize your the product you decide on, you're going to do a business plan, and you're basically going to do a 3 to 4 year projection, very detailed, line by line, every assumption detailed. But in theory, after the 4 years, or the 3 years or 4 years, whichever it is, of projections, you've still got something of value. If you created an entirely different business, we would use the Gordon growth model. And what the Gordon growth model basically does is say, okay, let me take my cash flow, and I'm going to divide by the weighted average cost of capital minus growth. And what that does is that gives you the value of the business from the time after you've completed your 3 to 4 year projections through forever. It's a relatively large number. So this is really what you would use if you were to create a new business or you were to acquire another company. The idea is that you're not just acquiring that company for 3 or 4 years, you're acquiring it forever, and therefore it's important that you understand what the value is after the 3 or 4 years you've projected. For our purposes, though, because what we're really creating in this course is a product, a new product that is going to have a set life. We've kind of decided to make it more realistic by saying, okay, you're going to do a 3 to 4 year projection, and then what you're going to do is rather than put a terminal value based on the Gordon growth model, which would say, let me assume this is a perpetual business, we're going to basically have you add sort of 4 years of cash flow, and that'll help you determine your IRR, net present value. And the idea is this would be realistic. A new program would maybe last for 8 years. The first 4 or 5 years you'd grow it, and then after that you'd sort of milk the cash out of it. Okay, what I want to do now is switch over to the Excel spreadsheet where I show you how to do some of these calculations. So what you're going to do is, after you've put together your operating plan, you're going to develop a set of financials, an income statement, balance sheet, and cash flows. And your cash flows are going to be relatively abridged. This may not be the exact format we use, but it gives you a pretty good idea of how it works. So what you're going to do is you'll do, let's say, an 8-year projection. You're going to do a 3 to 4 year projection. So as you can see here, we have a projection for year 1, year 2, year 3, year 4, and then in the out years, it stays at the 4.7 million of NOPAT. So basically, as I said earlier, this is a sample where you've done a 4-year projection, and then you're going to just basically say for years 5, 6, 7, and 8, we stay at the year 4 level. So the idea is we grow the business, and then we sort of milk the cash off of it. The first thing we're going to do is we calculate net operating profit after taxes. Why don't we use net income? Well, in part, this internal rate of return is going to be based on what happens at the parent company level. And the idea here is what you want to do is you want to be able to show if the parent company, for example, invests, and in this case we did this based on Unilever, if they invest $10 million to start this up, and they put, let's say, 100,000 of inventory in year 1, they're going to make net operating profit after taxes, or which is basically just your operating income tax affected. It leaves off the interest expense. Why? Because it's an operating number. And because we're going to use the cost of capital to discount these cash flows, we have to strip out the interest expense. So what we're going to do is we're going to have NOPAT. We're going to add back depreciation. In this case, for this particular example, we just didn't have any depreciation. We have to capture our working capital changes. And remember back to finance. Working capital is the opposite of the numbers that we include in the cost of capital. Weighted average cost of capital is long-term capital, capital that doesn't move, debt, equity, preferred. Working capital, by definition, is money that works through the system. What are the items in working capital? For the sake of our model, which is going to be pretty simple, it's going to be accounts receivable, inventory, and accounts payable. And if you remember back to finance and your finance and accounting courses in the MBA, Anytime accounts receivable go up, that means you're using capital, right? To the extent that you're loaning your customer money in order to purchase your products by not requiring them to pay in cash, you've received less cash. So if we start with no PAT of $1 million and we had to give, let's say, and I've just used examples here, $100,000 in receivables, well, that subtracts from our cash flow. Inventory, to the extent that you're growing your business, you're going to have to make an investment in inventory, right? You have to have product in order to sell it. And the bigger your business gets, the more money you have to have in inventory. Can you find ways to be more efficient? Absolutely. But if you're growing your business significantly, you're going to have more and more invested in inventory. Increases or decreases in accounts payable. Accounts payable is the opposite of accounts receivable. Accounts payable are basically the money that you owe your supplier in order to do business with them. So if you're Unilever, for example, you tell your suppliers, I'm going to take 30 to 60 to 90 days to pay you, and that account payable provides you with cash, right? Because you're getting your inventory from your suppliers and you haven't had to pay for it yet. So to the extent your payables go up, the idea is even though you're taking on a liability, you're improving your cash flow. And it almost sounds counterintuitive, right? To the extent that you're saying, well, if I'm adding to my inventory and my receivables, I'm adding to assets. From a cash flow perspective, that's not a good thing. That means you basically are adding that to your balance sheet by funding it either with cash. Accounts payable is money you owe others, but to the extent that it saves you from having to reinvest your own capital, it brings cash into the business. So what we end up with is a series of cash flows from operations. And you can see here that after year 5, the number stays at about 4.7 million. Notice in year 8, though, something that's what we do is we assume that we're going to recapture some portion of the working capital. And the idea here is once you go out of, you basically stop the business, you're going to get back some, you're not going to have to reinvest in inventory, you're going to collect all your receivables, excuse me, and you're going to pay all your suppliers. Again, this is simply an example. This is not, you're going to use the same format, but your financials will be completely different. So basically, you'll have 7 years of financials. In year 8, you'll have basically the same NOPAT, but you're going to have to wrap up your working capital. And this will mean collecting all your receivables. You'll basically sell out your inventory, and you'll have to pay off all your payables. Okay, so now we've looked at our initial investment, which is $10 million. And what you'll see here is what we have is we have total cash flow to and from the parent company. So from, in this case, it was Unilever, but in whatever company you're working on this year, this means that their initial investment was a little bit over $10 million. It was the $10 million invested plus the $100,000 of inventory. And in return, we received 8 years of cash flow. So now let's look at the IRR, net present value, and modified IRR. If we go to the formulas, what do? Well, we click on the function key. So in this case, we would use the net present value calculation. And you can see here, you'll be prompted. In this case, for this particular company, we had a 6% cost of capital. That's where you're going to put your weighted average cost of capital. Then you're going to value all the cash inflows. And in this case, the discounted value of all the positive cash flows was a little bit over $21 million. But in order to get to our net present value, we have to subtract out our initial investment. And when we do that, that gives us a net present value of a little over $11 million, $11,673. This means that discounting at the 6% cost of capital and subtracting out our initial investment of a little over $10 million, the cash flows generated by this gave us approximately $21 million in value. We subtracted out our $10.1 million of investment, and that left us with a positive net present value of $11.6 million. That basically, that particular measure is a positive. That says you would do the project. Let's look at the internal rate of return and the modified internal rate of return. Again, you start by going up to the FX key, and it'll prompt you, it'll give you this drop-down menu, and all you have to do is point and click on the cash flows. You would basically point and click, starting with your initial investment and going all the way through your last cash flow. That gives us an IRR of 24%. Our cost of capital was 6%. Our internal rate of return is 24%. The project's a go. And finally, let's take a look at the modified internal rate of return. So as you can see, the drop-down menu is almost the same. We're going to follow the same methodology. We're going to point and click, starting at our investment, going through that last cash flow in year 8. We leave the finance rate blank, but notice what we're going to do here for the reinvestment rate is we're going to put in our cost of capital of 6%. And this just means for the modified internal rate of return, the assumption is that we're going to reinvest at our cost of capital as opposed to 24%. Why? Because there's not that many 24% projects out there. When we do that, we end up at a 17% return. So if the parent company is looking at this project, they have a net present value of over $11 million. They have an internal rate of return of 24 and a modified internal rate of return of 17%. Both the internal rate of return and modified internal rate of return are higher than the cost of capital. The net present value is very positive. Therefore, you would do the project. This is the sort of analysis that you're going to have to do in order to justify your project at the end of the semester to the team of executives who will be evaluating your project. Notice the formulas are easy. Anybody can do them. Where the skill set is involved is whether or not you can accurately judge your cash flow. And we'll talk about this more when we talk about operating budgets, but where do most of the problems come? Generally, people tend to be either very aggressive in terms of their growth, assuming that a company can grow 30 or 40% without without spending a lot on marketing. Sometimes people are overly conservative. They just have a product that's growing 3 or 4% in a year. And obviously, the question that comes up from the team of executives is, why would we bother to do this if it's only a 3 or 4% growth business? And the other thing is being sure that you accurately gauge your costs so you have an accurate net operating profit number, and also your working capital costs. So again, this is all going to fit together, and sort of step by step what you'll do is you'll create your product, you'll develop the business plan to support that, and then the last step will be taking the financials you develop and putting them into this model to see whether or not there's going to be a satisfactory return to justify the corporation making the investment. Thank you very much, and now we'll go to our next session.